The United States owes $36 trillion in debt. China owes $15 trillion, Japan owes $10 trillion, and Germany, the UK, and France each owe around $3 trillion. Every major nation on Earth is drowning in debt. Total global debt has reached $317 trillion. This represents 330% of global GDP. We would need 3 years of total global production with zero consumption just to pay off this debt. The critical question nobody asks is, if everyone is in debt, who is the creditor? Who holds $317 trillion in assets if the world holds $317 trillion in liabilities? Debt is a zero-sum game where every borrower has a lender. If the U.S. owes $36 trillion, someone owns $36 trillion in claims on the United States. The answer reveals the largest wealth concentration mechanism in human history. This system works through the many borrowing and the few lending. Interest compounds forever in this system. The debt mathematically cannot be repaid, so it grows perpetually while funneling wealth upward. Understanding this system reveals how wealth concentrates in fewer hands while appearing natural and inevitable. Most people think debt works like personal borrowing, where a bank lends existing money. This is not how modern debt actually works. When governments borrow money by issuing bonds, the money doesn't exist before the borrowing. The act of borrowing actually creates the money. Central banks or commercial banks buy government bonds by creating money from nothing through ledger entries. When the U.S. government needs $1 trillion, it issues treasury bonds. The Federal Reserve announces it will buy $500 billion of those bonds. Commercial banks buy the other $500 billion. The Federal Reserve doesn't have the money. It creates it by typing numbers into a computer. The Fed's balance sheet increases by $500 billion in both assets and liabilities. Commercial banks do something similar through fractional reserve banking. The money didn't exist before, but exists now because of the bond purchase. Here's the critical part. Only the principal is created, not the interest. If the government borrows $1 trillion at 5% interest, it must repay $1 trillion plus $50 billion in annual interest. But only $1 trillion was created. The $50 billion for interest must come from somewhere else. It must come from future borrowing or from taxing the existing money supply. This creates a mathematical trap where total debt always exceeds total money supply. The system requires perpetual growth in debt just to service existing debt. This is not a bug. This is the design. 4 categories of creditors hold the $317 trillion in global debt. Central banks hold approximately $25 trillion in government bonds globally. The Federal Reserve holds $5 trillion in U.S. government debt. The Bank of Japan holds $5 trillion in Japanese government debt. The European Central Bank holds $5 trillion in European debt. The People's Bank of China holds $3 trillion in Chinese government debt. Central banks represent 8% of total global debt but form the foundation of the system. The Federal Reserve is not government-owned. It's a private institution. The Fed is owned by member banks like J.P. Morgan Chase, Bank of America, Citigroup, and Wells Fargo. These private banks receive a 6% annual dividend on their Federal Reserve shares. When the Fed holds $5 trillion in bonds and receives interest, that money ultimately flows to the private banks. The public believes the Federal Reserve is part of the government, but it's not. The Fed is a private banking cartel created in 1913 to allow private banks to profit from government debt. The Bank of England was created in 1694 as a private institution to lend money to the government. The government needed to finance war with France. Parliament authorized the creation of the Bank of England as a private company. The bank lent $1.2 million to the government in exchange for the exclusive right to issue currency. From the beginning, central banks existed to profit private bankers by creating government debt. Institutional investors hold approximately $120 trillion in global debt. This includes pension funds, insurance companies, mutual funds, and sovereign wealth funds. Pension funds hold $50 trillion globally. Insurance companies hold $35 trillion. Mutual funds hold $25 trillion. Sovereign wealth funds hold $10 trillion. Pension funds are theoretically owned by workers, but fund managers actually control them. Fund managers are paid based on assets under management, not worker interests. Insurance companies are owned by shareholders, with ownership concentrated among the wealthy. The top 10% of households own 89% of all stocks and bonds. Mutual funds like Vanguard, BlackRock, and State Street manage $20 trillion in assets. Vanguard is theoretically owned by fund investors, but management holds the real control. BlackRock and State Street are publicly traded, with ownership concentrated among wealthy shareholders. The pattern across all institutional investors is that control rests with a small management class. The ultimate economic benefit flows disproportionately to the wealthy. Foreign governments hold approximately $30 trillion in debt issued by other countries. China holds $3.2 trillion in foreign assets, including $850 billion in U.S. Treasury bonds. Japan holds $1.1 trillion in U.S. Treasuries. Foreign governments hold other nations' debt because of the trade system. When China exports $500 billion more than it imports, it receives $500 billion in dollars. China then buys U.S. Treasury bonds with those dollars. The system benefits both sides in the short term, but creates long-term dependency. Within China, the Communist Party elite who control the government holdings benefit, not average workers. Wealthy individuals and family offices hold approximately $40 trillion in financial assets globally. The top 1% globally holds much of this in bonds. The top 0.1% holds $20 trillion. The top 0.01%, approximately 500,000 families globally, holds $10 trillion. These families include the Rothschilds, Rockefellers, Waltons, Mars family, Koch family, and Saudi royal family. When you have $10 billion in wealth, you buy government and corporate bonds. A family with $10 billion in bonds earning 4% receives $400 million annually in interest income. They don't work or produce anything. They simply collect interest paid by borrowers. This is the core mechanism of wealth concentration through debt. The wealthy lend to everyone else and collect interest perpetually. The interest is paid through taxes, corporate profits extracted from workers, and mortgage payments. Wealth flows from the many to the few through the debt system. Adding up the four categories, central banks hold $25 trillion, institutional investors hold $120 trillion, foreign governments hold $30 trillion, and wealthy individuals hold $40 trillion. That's $215 trillion out of $317 trillion is accounted for. The remaining $102 trillion is held by smaller investors, corporate treasuries, and middle-class savers. But even this is disproportionately held by the wealthy because wealth is concentrated. The bottom 50% of humanity holds almost no financial assets. They hold debt. They owe mortgages, student loans, credit cards, and car loans. They are the borrowers. The top 10% holds most financial assets. They are the lenders. The answer to who is the lender is the wealthy operating through central banks they control, institutions they own, and direct holdings. The debt system is a mechanism to transfer wealth from the poor and middle class who borrow to the rich who lend. In medieval Europe, 1200-1500 AD, the Catholic Church was the primary lender. Monarchs borrowed from the church to finance wars. By 1500, the Catholic Church owned 25% of all land in Europe, largely acquired through debt foreclosures. The Medici family in Florence became the wealthiest family in Europe in the 1400s through lending. They lent to kings, popes, and merchants. The interest income from lending exceeded profit from any business. By 1450, the Medicis were so powerful they could install popes and influence kings. The Bank of England, created in 1694, was the formalization of the debt wealth system. King William III needed $1.2 million to finance war. Parliament authorized the creation of a private bank that would lend money to the government. The bank would receive interest paid by taxpayers and have exclusive rights to issue currency. This was the blueprint. Create a private institution with government-granted monopoly on money creation. That institution lends to the government while taxpayers pay interest to the private institution. The institution's shareholders become wealthy through perpetual interest income. The Rothschild family perfected the system in the 1800s. Mayer Amschel Rothschild had 5 sons whom he sent to 5 European capitals. Each son established a bank in London, Paris, Vienna, Naples, and Frankfurt. The family lent to every European government. After Waterloo in 1815, the Rothschilds held more government debt than any family in history. Nathan Rothschild in London famously said he didn't care who sat on England's throne. He said the man who controls Britain's money supply controls the British Empire, and he controlled it. By 1850, the Rothschild family held an estimated 50% of all government bonds in Europe. They collected interest from every major nation. The wealth they accumulated through lending exceeded the wealth of most nations. J.P. Morgan, in the early 1900s, America used the same model. Morgan lent to governments, railroads, and industrial corporations. By 1912, Morgan controlled banks that held 25% of all financial assets in America. The pattern across 800 years is identical. Those who lend become wealthy. Those who borrow become dependent. The lenders accumulate wealth through interest income without producing anything. The borrowers work and produce, but owe ever-increasing amounts. The system is designed to ensure the debt can never be fully repaid. The mathematical trap is simple. When money is created through debt, only the principal is created, not the interest. This means there's always more debt than money. If total money supply is $100 trillion, but total debt is $120 trillion, including interest, it's impossible to repay all debt. The only way to service existing debt is to create new debt. You borrow new money to pay interest on old debt, making total debt larger. This requires even more new borrowing. The debt grows exponentially. Global debt has grown from $40 trillion in 1990 to $317 trillion in 2025. That's a 7.9 increase in 35 years. The debt doubles approximately every 10 years. It must keep growing because if new debt stops being created, there's no money to pay interest on existing debt. If that happens, the system collapses. The people who designed the system understood this. The Bank of England's founders in 1694 knew that once the government borrowed $1.2 million, it could never fully repay. The interest owed would always exceed the money supply. This is not a flaw. This is the feature. Perpetual debt means perpetual interest income. Perpetual interest income means perpetual wealth transfer from borrowers to lenders. In 2024, global interest payments on $317 trillion in debt were approximately $15 trillion. That's $15 trillion flowing from borrowers to lenders in a single year. Governments pay interest through taxes. The U.S. government pays $900 billion annually in interest on its $36 trillion national debt. That $900 billion comes from taxpayers and goes to bondholders. Corporations pay interest through profit extraction. Corporations hold $90 trillion in debt globally. They pay approximately $5 trillion in interest annually. That money comes from the difference between what they pay workers and what they charge consumers. Households pay interest through wages. Households hold $60 trillion in debt globally. They pay approximately $3 trillion in interest annually. A family earning $70,000 per year, paying $15,000 in mortgage interest and $5,000 in other interest, sends 29% of their income to creditors. The $15 trillion in annual interest payments flows from taxpayers, workers, and households upward to central banks, institutional investors, foreign governments, and wealthy individuals. The top 1% globally captures approximately 40% of the $15 trillion annual interest income. That's $6 trillion per year, flowing to 80 million people. The top 0.1% captures 20%, which is $3 trillion flowing to 8 million people. The top 0.01%, 800,000 people, captures 10%, which is $1.5 trillion. 800,000 people receive $1.5 trillion annually in interest income from a debt system where 8 billion people are borrowers or taxpayers. That's $175 million per person in the top 0.01% from interest income alone. This is the wealth concentration mechanism. Debt funnels wealth from billions to millions to thousands to hundreds of families at the very top. The concentration accelerates because interest income compounds. If you receive $10 million in interest income, you use it to buy more bonds, which generate more interest. You then use that interest to buy more bonds. Wealth compounds exponentially for creditors, while debtors stay trapped in perpetual repayment. The Rothschild family in 1850 held $2 billion in assets. Through 175 years of compound interest, the family's wealth is estimated at $500 billion to $1 trillion. They didn't build businesses. They lent money and collected interest for 7 generations. This pattern repeats across every wealthy family. Initial wealth was built through business, but perpetual wealth is maintained through lending. They own bonds, collect interest, and reinvest. The system guarantees their wealth grows forever as long as the debt system continues. The system must continue because if it stops, everything collapses. Governments need debt to function. Corporations need debt to grow. Households need debt to buy homes, cars, and education. The entire modern economy is built on debt. Debt requires creditors, and the creditors are the wealthy. The wealthy use the debt system to extract wealth from everyone else through interest payments that can never end. The debt can never be repaid, but the system has a mathematical endpoint. The debt cannot grow forever. Global debt is 330% of GDP. Debt is growing at 7% per year, while GDP is growing at 3% per year. By 2035, global debt will exceed 400% of GDP if current trends continue. At 400%, interest payments alone would consume 40% of global GDP. That's unsustainable. Something breaks. Either governments default, which wipes out bondholders but collapses the financial system, or governments inflate, which transfers wealth through currency debasement but destroys savings, or governments impose debt jubilees, which cancel debt but restructure society. All 3 outcomes destroy middle-class wealth while protecting the elite. The elite hold hard assets, multiple currencies, and geographically diversified holdings. The middle class holds debt, local currency, and undiversified assets. This is by design. The system was designed to concentrate wealth during both expansion and collapse. During expansion, the wealthy collect interest on perpetual debt. During collapse, the wealthy buy assets at fire sale prices from bankrupt borrowers. Happened in the Great Depression when banks foreclosed on farms and wealthy investors bought them. Small farmers became tenant farmers. This happened in 2008 when homeowners defaulted. BlackRock, Invitation Homes, and private equity firms bought hundreds of thousands of homes at 50% discounts. Home ownership decreased while corporate ownership increased. This will happen in the next crisis. When the debt system breaks, the middle class holding debt will default. The wealthy holding assets will buy the defaulted assets at discounts. The $317 trillion debt system is not a crisis. It's a wealth extraction mechanism. It's designed to transfer wealth from the many to the few during both good times and bad. You cannot escape it because the system is global and totalizing. You pay interest on your mortgage to a bank owned by shareholders who are disproportionately wealthy. You pay taxes that service government debt owned by bondholders who are disproportionately wealthy. Every economic transaction includes an interest component that flows upward. The average American pays $20,000 annually in direct and indirect interest. Over a lifetime, that's $1.4 million in interest payments flowing from you to creditors. Those creditors are on average 100 times wealthier than you. This is the system. Create money through debt, charge interest, collect perpetually, and concentrate wealth in creditors' hands. The system ensures the debt can never be repaid, so the interest never stops. The lender is a small global elite operating through central banks they control, institutions they own, and direct holdings they manage. They are creditors to everyone else. The interest payments from 8 billion people to the top few million is the largest wealth transfer in human history. This transfer happens every single day, invisibly embedded in every transaction. Even the collapse will benefit the creditor class, because they'll convert paper claims into hard assets during the crisis. The system extracts wealth during expansion and during collapse. The people who designed the system ensured they would always be creditors, while everyone else would always be debtors. That system, operating through $317 trillion in debt and extracting $15 trillion annually in interest, is the mechanism by which the modern global economy transfers wealth from bottom to top perpetually and inevitably. The next question is, what happens when $317 trillion becomes $500 trillion and interest payments exceed global GDP? There are three possible outcomes: default, inflation, or jubilee. The elite are positioning for one of these outcomes. All three outcomes transfer wealth from the middle class to the top. The $500 trillion question is what comes next. The answer determines whether you preserve wealth or lose everything when the debt system finally breaks.